Investing in overvalued stocks can be analogous to playing Russian roulette with your capital. PayPal was a classic example. This stock came out with a lot of fanfare and a lot of hype, and the market maintained a very high valuation of over 35 times earnings, which is the blue line on this graph. And you can see the post-COVID pandemic, the stock got really crazy. The PE went up to just astronomical numbers. The PE got over 72. But what this led to is a little bit of bad news. The company had faltered. You can see they've consistently grown their earnings, but the company faltered just a little bit, and the stock fell over 74% from July of 2021 to May. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Welcome you once again to a subscriber request Tuesday. However, today I'm doing it on Thursday because I was traveling. But regardless, I'm finding this series interesting and a little bit wieldy, to be honest with you. This last week, we got over 80 stocks, and I've narrowed that down to 40 stocks that I'm going to be covering in the video here. And I got it, narrowed it down to 41. And what I find very interesting about this is the types of companies that you are asking to see. I think that's maybe one of the most interesting part about what's going on here, because if you look at it by sectors, we've had an awful lot of interest in consumer staples. We've had, as usual, a lot of interest in financials. And if I blow that up a little bit more, we have information technology also being a popular request. So I do find this series very, very interesting from the point of view that I like to know what you guys are interested in and what you're looking at. But I think that this particular week, what I really found interesting was the diversity of the requests, how many different types of companies that you guys were asking for. Now, when I cover 49 stocks in a video, obviously I cannot go into an in-depth analysis. Some of these I know something about, some of these I know nothing about. I want to make that clear. These are companies you requested, that you asked for, and I'm just going to go over and give you a real quick, my 2 cents opinion, so to speak, my, instant summary based on what I see on the fast graphs. And what I'm also going to do here in this is basically, I think you're going to see the difference between, the types of stocks that exist. As I've always said, I believe it's a market of stocks, not a stock market. Stocks are as different as people are. And to think of it in terms of what the market's going to do, I've always felt was a mistake. You really want to think individually about the individual stocks you own. That's what really matters. And of course, you always want to pay attention to valuation. Like I showed in my, first example with PayPal there, it was, a very, very overvalued stock. And when you're investing in a stock that's so highly valued, I pointed out it's like playing Russian roulette with your money. It just takes a small catalyst. In the case of PayPal, it was a slight dip in earnings to literally collapse the stock. And of course, we ran head on into this quote unquote bear market or approaching bear market that we've been, testing here for the last week or two. So I'm going to go through these very quickly. I'm just going to cover them. I'm just going to give you a basic opinion. As always, I like to orient you to fast graphs. The orange line represents the earnings or whatever other metric I'm using. The black line is weekly closing stock prices. The blue line is what the market normally values them at. The white line is the dividend, if any, and the area below the white line is the dividend payout ratio. And then this light green shaded area is the portion of dividends that are paid out to the shareholders. So very quickly, Abbvie has been undervalued, in my opinion, for several years. I'm very long on this stock, I might point out. I do consider it undervalued today, but as you noticed, it has rallied, pretty strongly here in the last year or so. It's currently yielding 3.71%. It can still be bought at 11.48 times earnings, blended PE, and the earnings yield is 8.71%, which I consider to be very attractive. The company's BBB+, but it does carry a lot of debt. So that's Abbvie. I think Abbvie is still attractive, but obviously it's less attractive than it was a few years ago. You can see that, when valuations are low, the stock actually has been rallying now for several years. So that's Abbvie. The next one is Accenture. And I really like this example because this has been a really terrific growth company, almost 13% annualized growth historically. You can see that up until we came out of the recession, the stock was trading at, somewhere between 15 and 20 times earnings. That's the orange line and the blue line on the graph. Then we got this irrational, exuberant, optimism, hype, whatever you want to call it. As Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. I think investors got really greedy with this stock. It has corrected significantly just in the last few months, but I still believe this is a majorly overvalued stock based on any other metric that you'd want to look at. So I still think Accenture, although a very high quality company, it's AA- rated, is one of the companies that I like to covet. It's a company that I want to own if I could, but I've got to be able to buy it when the valuation makes sense. So it's corrected, but I don't think far enough yet. AFC Gamma is a mortgage REIT. This is a very interesting one, offers almost a 10% yield. You can buy it at 8 times earnings. Earnings yield is over 12%. This is a mortgage REIT, and it's kind of unique in a lot of ways compared to other mortgage REITs. It's only been a public company for a very short while. It does offer a terrific yield. I think this is one probably worth researching further, but at the same time, keep in mind there's a lot of risk in a stock like this. When you see yields this high, don't mistake the fact. So you really want to do your homework if you're going to invest in AFC Gamma Inc. Ameriprise is a company I own. You can see the stock really tracks its earnings beautifully. It was trading at a fair value, but a full value here for the last couple of years. This market has given us an opportunity to buy it cheaper. This is a total return investment, looking at 13 to 14% growth going forward. That could generate very strong double-digit rates of return if you had the courage and the foresight to invest in Ameriprise Financial today. This is This is a spinoff from American Express. Anthem is another stock that I own. I really love the consistency of this company. It only offers about a 1% yield now. I was buying this stock when it was undervalued. It has now moved into overvalued territory. So although I love Anthem, I think it's one of the finer managed healthcare companies in the country. I do think it's fully valued now. It doesn't mean you'd lose money if you invested in it, but I don't think you would get the full measure of what the company's capable of delivering. So I love Anthem. I just think it's overvalued. Digital Turbine is another example of one of these growth stocks, like I showed you, PayPal. It's application software. The market really gets excited about stocks sometimes, and you've got to be aware of that. And I call this the obvious mistake. This stock was way too expensive. It kind of ran into a wall here in 2021 and then simply has collapsed. This year it's got plenty of growth potential, growing at over 30% a year. If you look at it from a price to sales point of view, its sales are expected to continue to grow at 30% a year. So if you're a growth stock investor, this could be very attractive now for the first time in the last couple of years. But again, there's a lot of risk in this because generating the kind of growth that this company is expected to grow is very difficult. Historically, it's grown at a very astounding rate. Notice when I shorten the time frame how that growth rate changes. But going forward, it's expected to grow at about 30%. So, it's one that you could be looking at from a standpoint, if you're a growth stock investor, it might be interesting. Boeing is, interesting. I wanted to show this because this company had all kinds of problems. Of course, they slashed their dividend, eliminated it actually. They got caught in COVID. Airlines were canceling their contracts. No one was flying. The stock is still, even after all this correction, I would still call this stock overvalued. I think theoretically at 15 times future earnings, it's worth about $89 a share. So, whether they reinstitute a dividend or not is yet to be determined. Best Buy, is obviously the computer and electronics retailer. Everybody knows it. It does have a really good long-term track record, growth over 10%. If you just look at it for the last 7 or 8 years, growth has been about 15 or 16%. Forecast to grow at about 7% going forward, and long-term at about 8%. So based on that, the company looks very inexpensive to me with over a 4.4% dividend yield, earnings yield of 11.9. I think Best Buy has become attractive now. It's a investment grade company, BBB+ rated. And if you were going to invest in Best Buy, now's the time to be greedy when other people are afraid. Franklin Resources, I wanted to show this because I get a lot of questions on this. They've paid a lot of special dividends in the past. They're yielding over 4%. The PE is only 7. But one thing I want you to basically focus on here When I shorten the time frame here, this company since 2014 or so has really had negative growth going forward. Forecasting growth is negative going forward. So even though you've got some nice statistics here, and that's one reason I wanted to showcase this one, I think you ought to be very careful. There's a lot of reasons why some of these fund companies are struggling. You want to do your research on this. The stock is cheap. That's one thing I'll say for it. But I think you'd be facing, future issues that you need to be aware of at least. Big Lots, is a company that earnings grew pretty well. The stock does again offer a 4% dividend yield. Once again, when you look at this, we're looking at a negative year this year. So I think you might want to expect some potential negative, but this is the part that I really don't like about it. The stock is expected to shrink at a double-digit rate over the next 5 years. I cross-checked that, by the way, using the external links on FastGraphs and went into Yahoo, and Yahoo thinks they're going to grow at a negative 10% rate at all. So even though this stock is cheap, it's cheap relative to what the earnings are now. You want to do your homework and, make sure that you're investing in something here that makes sense. BMW is a company. It's one of the, top car companies in the world. I show this because what I've never liked about car companies is that they're just so very inconsistent with, with their operating results. It's very hard to predict these. We've had a hot car market here recently, so we've had really good cash flows lately. Sales have been actually steady and strong over the years. But the bottom line is, I just don't think it's easy to make money in a car company, so I've never liked them. Berkshire Hathaway is obviously one of the real popular stocks. I'm going back to 2002 here. The growth rate, I'm going to shorten the time frame so I can calculate a growth rate. It's been about 8.5%. The market likes to put a premium value on this stock. It's starting to approach back to that fair value of the fair market value. I don't call it the fair value. I think this stock is always expensive, and part of that would be the reputation of, Warren Buffett and Charlie Munger. And keep in mind, they're not getting any younger, so you might want to take that into consideration. Looking at it from their normal 20 to 25 multiple, the stock would be a reasonable buy now if you're looking for pure growth. And notice that there's no dividend, and Warren Buffett doesn't believe in paying one. British American Tobacco is obviously a tobacco company. It's got decent growth. It's been very inexpensive for the last several years. It offers a 6% dividend yield, earnings yield of over 10%, blended PE of under 10. If you're ever going to buy tobacco stocks, I do believe that now would be the time to look at British American, and you could also say the same about Altria and others. Cracker Barrel, the one thing that I think is confusing with these restaurant stocks right now is that COVID came and they had to shut their doors and they had to reinvent their business model. It rallied strongly right after COVID. They have paid some special dividends. That's why the dividend is so high, and that's why you see such a high payout ratio on the dividend over time. But the bottom line is the company has had the cash flows to cover those dividends and pay them. Earnings have been a little bit of a different matter, but the company is expected to recover now. If you're looking at forecasting, the stock would be reasonably attractive here, and the company is expected to grow at about 17% this year before they're expecting a negative growth rate. The long-term growth rate is expected to be about 10%, so Cracker Barrel could be getting into fair value territory if you're interested in owning a food stock, so you might want to take a closer look. Carter's, which is apparel, accessories, and luxury goods. They went through the COVID crisis, obviously, like most retailers did. The stock collapsed. It did recover. It is now very cheap. It does offer a 4% dividend yield. And notwithstanding COVID, it has a pretty good long-term dividend record. So you might want to take a closer look. It's only a double B plus rated company, however. And the company does have reasonable debt at only about 37%. The next is John Deere. This is a relatively cyclical company. Notice that it reacted to the earnings recovery that was, coming. The stock then got overpriced. It's now come into fair value. It would be reasonably attractive if these estimates are correct at these levels, but this would be a time to start looking at Deere. I don't know if it's a time to buy it yet or not, but it looks a lot better than it did a year ago. Emerson Electric, this is a chronically overvalued stock, and what I mean by that is the market likes to put a premium value on the stock. even though it's somewhat cyclical. It's an A-rated company. It's really a high-quality company, electrical components and equipment. You can see how the price is tracked at 18 multiple. It's trading just below that now, offering a 2.5% dividend yield. And by the way, historically, the company has grown their dividend at 4 or 5% a year. So, this is just a blue chip that you can invest in, but you want to be aware of the fact that, the market likes to put a premium valuation on this company. Evertec, which I'm not familiar with, is data processing and outsourced. Somewhat of a spotty record. The company, the price has gone where the earnings go. Note when the earnings flattened like this, the market got real pessimistic and the PEs got real low. It fell from being slightly overvalued and is now reasonably priced. So there's your Evertec, for those of you who asked. Fastenal is another example of a stock the market likes to put a premium valuation on. They occasionally pay a special dividend yielding about 2.4%. It would be in value based on market value, a normal PE of 30, but I would still consider this stock overvalued. I've always admired this company. I've never been able to invest in it because I wasn't willing to pay a multiple of 30 times earnings with an earnings yield of 3.5%. That's half what I basically look for. Now, I did want to show this. Someone asked me about Fossil, and I thought this was a very interesting company. I know nothing about it. It's apparel, and this is the problem with apparel stocks. And even looking at a stock like Big Lots I showed earlier, these stocks can get very hot. They can get very, emotionally involved. They can have a lot of momentum at times. But just look how the price ultimately follows the earnings. That's such an important principle to keep in mind. That's why I think fast graphs are so valuable, because beyond just looking at the price and looking at some basic metrics, you get to see the company's price in relationship to how the business has performed. The next one is Globe Life. It's a life and health insurance company. I believe this is, buy term and invest the rest company. It's got good, steady growth, good, steady dividend, very low payout ratio. Payout ratio is, around 10 or 11%. Doesn't offer much in the way of dividend yield. This is strictly for a total return investment, in my opinion, where you're investing in a company that's A-rated, very high-quality company with a good long-term track record of growth. And they even went through COVID. They even went through the last recession, without being scathed at all, hardly. The next one is Corning. Corning is electronic components, very cyclical company. It does have a very good dividend record. Dividend yield is over 3% now. The stock is trading at what I would call a reasonable valuation. But again, keep in mind the cyclical nature of this company if you were going to look at taking a position. Now, here's Golden Ocean Group. It was a maritime company, a shipper. People have asked me for. I think the reason people are asking, they have this massive dividend yield. They have this very low valuation. But, this company's destroyed capital for years and years. Now, what the analysts are looking at going forward, I believe is suspect personally. This is not the kind of company I would invest in. If you look at their analyst scorecard, analysts have missed estimates, most of the time with a company like this. So I think it's a very, very difficult industry, very, very difficult company. But I, was asked to show it, so I went ahead and covered it for you. International Money Express is, a growth stock that's trading at a very reasonable valuation relative to its normal growth. Its forecast to continue growing at around 15%. And long-term growth, we're not getting a forecast. So bottom line is this would be a higher risk, small cap growth stock if you're interested in that kind of investing. Some of you are, some of you aren't. Intuit, I've been asked for several times to show this. I've been reticent to show it because this company, you can see, traded at, at its growth rate for many, many years, 15 to, we'll call it 17 to even up to as high as 30 times earnings, which is the blue line. I think the stock has been massively overvalued. More recently, it's dropped significantly, but I still would consider this one overvalued. I wouldn't be interested in investing yet. JP Morgan, diversified bank, reasonably priced, 3% dividend yield, earnings yield almost 11%, trading under 10 times earnings. You probably can't go wrong investing in JP Morgan at these levels if you're interested in investing in diversified banks. Lennox, which is building products, very steady grower over the years, offers a 2% dividend yield, is trading with a nice margin of safety for the first time in years. It's forecast to grow at about 9% which if that's true, there isn't really a big margin of safety here, but relative to its historical growth, it's trading at one of the best valuations. You might want to do your homework here and take a closer look at Lennox. Lincoln National is an insurer. I can show lots of insurers, life and health insurance. They've all been trading at very low multiples for a long time, but now they're trading at less than 7 times earnings with a 3.29% earnings yield. It is expected to give some pretty strong growth going forward for the next 4 or 5 years. This could be an opportunity to invest at a very attractive valuation in a A- rated life and health insurer. So that's, looks pretty good. Lovesac, this is home furnishings. This company is interesting. They make these couches that you assemble and unassemble. You can see the market really liked this stock for years. It got very overpriced. It does have decent growth expected, although it's going to consider to have a flat year, which I think partially explains the down numbers. I'd be careful with this one, but it is a growth stock and it does offer growth potential. The question is whether or not they can pull it off or not. The forecast is, the analyst estimates have been, scorecard rather has been too short for me to really give it much credibility, but that's Lovesac Company. This is Louis Vuitton. They've paid a special dividend in the past. The stock, had a nice rally here for earnings in 2021. It got pretty overvalued. It's now moving back into fair valuation territory. So here's one that you might want to take a look at if you like apparel companies, but I would still be waiting for this one. I wouldn't be interested in investing in them yet. Lazy Boy, home furnishings, the famous Lazy Boy recliner. The stock has had a good growth record here coming out of the recession. The business performed pretty well during COVID. The stock price didn't, but it did rally. It's now very inexpensive, offers a 2.68% dividend yield, earnings yield over 12%. Those are good metrics as far as I'm concerned for Lazy Boy, but it does not even offer a credit rating, so do your homework. Here's Altria. I talked about Philip Morris International before. These stocks have been cheap for the last several years. I think they're holding up very well, though. They do offer over a 6% dividend yield. I've covered this recently in other videos, so, just what it looks like today, just so you can see it since you asked. Mettler Toledo is life science tools and services. I really believe this stock is massively overpriced, and I still think it's overpriced. Doesn't pay a dividend. Again, I think this is an example of playing Russian roulette with your money. Great company, by the way. We've got a very consistent growth record, almost 15% a year, but I don't like the valuation at all. The NASDAQ Stock Exchange is very interesting. You want to buy this one when it's cheaper, as this graph clearly shows. It does offer a decent yield. It has corrected, but I still think it hasn't corrected enough, especially with what we're facing. Here's another regional bank, Bank of Ozark. Looks very, very attractive with a 3% dividend yield, under 10 times earnings. A lot of financials are inexpensive. Philip Morris International, in contrast to what we just saw with Altria and British American, I think is overpriced right now. It does offer a decent yield, but I don't think this is a good entry point. I would look for it to come down. It's actually expected to have a down year this year, so there could be some shoes to drop, some negative shoes to drop. Progress Software is a very interesting company. They recently started paying a dividend. Their dividend record has been pretty good, at about a 1.5% yield. The company does offer some appreciation potential based on the stock, moving back into a 15 PE ratio. But again, it's inexpensive. It depends on what your goals and objectives are. PayPal I featured. I really think this is a classic example of how dangerous overvaluation can be. Because the market gets all hyped and excited. There's a lot of tech stocks that are like that now. And it doesn't take much, just a slight dip in earnings here for the stock to really get killed. Now, based on other metrics like price to sales, this stock is traded almost at 7 times sales historically. It's now trading at half that rate roughly. So that could be an attractive entry point for a popular growth stock. But keep in mind, it was not a good investment back here. Ross Stores is a really good retailer. There's their sales graph. It's trading at a 1.5 times sales. It does offer a nice dividend yield, about 1.5%. It obviously struggled with COVID. I think when you're looking at these retailers, you got to overlook COVID because it really had nothing to do with management. It had everything to do with what was going on with COVID and the fact that they were shut down and, they had to change their business model. But right now it's moved back into reasonable territory. I wouldn't call it cheap yet, but you might want to take a look at Ross Stores. Scott's Miracle Gro was just massively overpriced. It did have some really good years. It has paid special dividends in the past. I think the stock has become inexpensive today based on, the historical graph, but based on forecasting, it still might be a little bit pricey. So I'd be careful with Scott's. I'd research it thoroughly. Semler Scientific, don't know anything about this. Healthcare equipment. If you look at it, it's had decent growth here, but it was, again, a massively overvalued stock that just hit a little bit of bad news. And you can see, just like we saw with PayPal, the correction here was over 80% in this example. Investing in high growth stocks at real high valuations where you're paying 70 times earnings and so on, to me is clearly, as Mr. Valuation, playing Russian roulette. Now, STAG is a industrial REIT, so you want to look at it from price to FFO. I think this stock has become reasonably priced with a 4.48% dividend. I'd like to buy it a little cheaper personally, but I think it's actually an attractive buy now. You could start building a position in STAG because the stock has come off of its lofty valuation and become reasonable. Store capital, I would say about the same as I did with STAG. It's a real decent REIT. It's got a 5.7% dividend yield. I think this is an attractive, let's call it an attractive buying range today. The next one is Tempur-Sealy. This is the Tempur-Pedic mattress. The company's had, a little bit inconsistent, but really strong growth historically coming out of COVID. They've really had some really good years of growth, but the growth has faltered a little bit. And again, when a stock is trading at high valuations and, based on a high growth, and that growth falters, the price can correct very quickly. Tempur-Sealy International does look like it has a great margin of safety. It's an attractive little dividend yield, trading at half what it ought to be worth. That would mean if it moved back to a 15 PE ratio, and I just want you to see that, the company has historically traded at 17 times earnings. So saying moving back to 15 times earnings would not be a stretch, and the amount of money you could make if that happened, it's somewhat speculative, would be very, very strong. So there's Tempur. Uber is, we all know who Uber is. Uber has had all kinds of fans, it's hype, momentum, and you can see the stock has really been a very poor performer over the last couple of years, and I still think it has more damage to go. The stock's still not really making any money. Now the one thing going for Uber, I guess you could say, is the company does have strong sales, and their sales are still expected to be strong going forward. But, this is talking at paying 5 times sales, which is a high multiple of sales. From an earnings point of view and from an operating cash flow point of view, I think the stock is still very expensive, overvalued, in other words. VF Corporation, I wanted to show this one because it's very interesting, when you're looking at companies like this. If you notice down here at the bottom of the graph, starting in March of 2018, they shifted their fiscal year, and it kind of messed up the numbers. So you've got some, issues with the data here from an apples to apples point of view, but it is, we have been able to smooth that out. The company is, known for their blue jeans, I guess would be the best. Vanity Fair is what they used to be called. It got very overpriced during COVID. It collapsed, got very overpriced after that. It's now collapsed again, offers a 4% dividend yield. I consider this a very high quality company, A- rated. If you were going to invest in VF Corporation, I believe now would be the time. And if it dropped any more, I'd be an aggressive buyer of adding to the position. Walker Dunlop is thrifts and mortgage finance, just another financial. It's still trading above what the market has been valuing it at for the last decade, but it's certainly a lot closer to fair value now than it was. So thank you for asking that one. Walmart, Walmart showed the effects of overvaluation when it got overvalued, in 2000, 2001, and 2, and it stayed overvalued for many years, and the price did absolutely nothing. Investors actually had negative rates of return, even during a time when the stock did well. I consider it overvalued now. It has corrected strongly. I featured Target in just a previous video. This one is still, in my opinion, way overpriced for what it is. This is the pharmaceutical company. Market likes to put a premium valuation. It's coming closer to that, but I just don't see the economics of investing in this stock. I think I could get 10% growth a lot of other places and do it a lot cheaper. Anyway, this has been Chuck Carnevale. Whew, that was hard to go through 49 stocks for you. I've got to figure out something to do because I really appreciate you guys making these investor requests, but obviously I can't do justice to any of these companies. I can just kind of preview them and give you a perspective of what they look like. I have to leave it up to you to do your own homework and do your own research if you like what you see or if any of these stocks meet your investment objectives. Anyway, this has been Chuck Carnevale. Thanks for watching. If you like this video, ring the bell, give me a like, and subscribe to the YouTube channel. And also take a look at fast graphs. You can just see how valuable they are looking at all the different kind of stocks that are out there. Anyway, thanks for watching. Talk to you guys again soon.